If this position were correct, I think we'd have to begin to think seriously about the crisis of U.S. imperialism or empire because of the centricity of the U.S. Treasury standard to the operation and extension of the U.S. power. But it is at least premature, I think, to predict the long-term decline of the greenback. So far as I can see, the most important empirical patterns indicate that the global economy remains strongly committed to the US dollar and to the dollar standard. In particular, this is where my research really begins to come to light, the voracious demand for US securities that has been the most important support pillar for the US dollar standard since the beginning of the post-World War II period remains strongly in place, meaning that global investors have not changed their minds on the basic attractiveness of U.S. assets and continue to provide an unparalleled demand base for the outward flow of U.S. domestic securities. And Chris, of course, made light of this up until at least 2005, as the chart indicates. But the trend, despite forecasts by some economists, remains firmly in place, and I'll get to this now. Recent flows of funds in the international bond market, which is the largest and I think most important database for gauging the global appetite for U.S. domestic securities, illustrates this position very well. And I'll make 3 summary points that draw on some statistical analysis, so just bear with me for a second. First, again, as Chris has pointed out, the foreign purchase of U.S. federal issues has been consistently high since 2001. And more recently, from December 2006 to September 2007, the foreign purchase of U.S. Treasury debt increased by $130 billion to a record $2.25 trillion. Disaggregated by fiscal quarter, in fact, the 2007 increase in foreign ownership of Treasury debt outperformed the 10-year moving average in 3 of the 4 periods. Second, the changing composition of foreign reserve holdings between 2006 and 2007, often noted by those eager to pronounce the erosion of the dollar standard, has in fact been historically measured and consistent with previous cyclical patterns. Central banks and global investors more generally have priced in decline in U.S. fundamentals. But the composition of dollar reserve holdings has shifted only modestly and remains well above levels reached as late as the 1990s. Further, the net change in U.S. dollar reserve claims was not only positive in 2007, but historically high. Which is to say that the percentage decline in dollar reserve holdings often noted has resulted from the tremendous increase in the foreign purchase of alternative currencies. I think it's a significant point. Third, industrial economies where U.S. capital penetration is the deepest, as Leo and Sam have often indicated, continue to demonstrate remarkable support for the reserve position of the dollar. In these countries, dollar reserve holdings remain historically high and well above aggregate levels, despite the vast current problems. Now, all this does not mean that the foreign bias towards holding U.S. securities has been essentially constant. And rethinking today how to assess the global monetary system, it is wrong, I think, to argue that the subprime crisis has not impacted the foreign perception of U.S. securities or the short-term stability of the greenback. The dollar standard is not, we must remind ourselves, invincible. Rather, it is rooted in social relations and the perception among market participants that U.S. Treasury debt is uniquely liquid and permanently exchangeable, what Weber has called the substantive validity of money. But, and I'll move towards a conclusion on this point, the present decline has all the markings of a cyclical shift in foreign exchange values. Consistent with previous historical patterns, investors in the international securities market, and particularly, as I noted, the international bond market, have minimally diversified their foreign exposure to protect against declining U.S. fundamentals and to speculate on interest rate differentials, more importantly. But they have not given up on the special value of the U.S. dollar, purchasing almost without exception more and more U.S. assets. This strongly mitigates against negative flows in other corners of the foreign exchange market, and if indirectly, deepens the international commitment to the dollar. When the dollar standard enters its actual phase of decline, this shift from historical patterns will be much more poignant, I think. Thus, while the subprime crisis is quantitatively different from other episodes of decline, and thus presents the US Fed and the Treasury with a unique set of dilemmas, the market reaction does not, as of yet at least, have an otherworldly quality. Being statistically comparable to episodes of dollar decline in the 1970s, 1980s, and perhaps to a lesser extent in the 1990s. Now, it is by now almost certain that the US economy will enter recession and the global economy will follow in the same general direction. But we must be careful not to assume that the Treasury standard will be an inevitable casualty of these very serious events. In good part, because of the managerial capacity of the US Fed and Treasury, the special position of the dollar and the dynamism of American imperialism has proven remarkably resilient to violent economic cycles. Whatever the complexity of the current or the impending economic decline, and I think it's somewhat problematic to make firm predictions on where it's going as of right now, due allowance must be made for the complex of forces, social and the market forces, that sustain the U.S. empire.
Great. Thank you very much, Scott.